Welcome back to the Global Ledger. I'm Justin. In the last episode, we talked about how prices are actually made. And we said that this wasn't, an opinion or models, but by orders interacting in real time. Today, we're going to focus on something every trader sees and very few understand. That is the bid-ask spread. That small gap between buying and selling looks trivial in calm markets. But that gap is doing far more work than most people realize. Because the bid-ask spread is not friction, it's the price of immediacy. Let's get into it. At the most basic level, the bid is the highest price someone is willing to buy. The ask is the lowest price someone is willing to sell. The spread is the difference. But economically, the spread represents compensation. Compensation for providing liquidity, holding inventory, absorbing adverse selection, and taking risk over very short horizons. No spread means no incentive to make markets. Okay? No spread means no incentive at all to make markets. And when you place a market order, you are asking for execution now and at whatever price is available. That immediacy has value. Someone on the other side must commit capital. They must accept uncertainty and manage the risk of being wrong. The spread is the payment for that service. Okay, markets don't charge commissions for speed. They charge spreads. So spreads are not arbitrary, okay, either. So they widen and narrow based on volatility, order flow, inventory, information, right, and time of day. So when uncertainty rises, spreads widen. Not because participants are greedy, but because risk has increased, okay? And spreads, I think, are a measure of liquidity, okay? Liquidity is often described abstractly, okay? But spreads make liquidity visible. Tight spreads mean abundant liquidity, competition among providers, and low perceived risk. Wide spreads mean thin liquidity, cautious providers, and elevated uncertainty. Okay, spreads are the market's stress gauge. And one of the most important microstructural insights is this. Markets don't usually move violently first. They become expensive to trade first. Spreads widen, depth disappears, and execution slows. Okay, price moves come later. If you watch spreads closely, you often see stress forming before you see it, in the headlines. So who earns the spread? Okay, we've talked about this in the previous episode, or touched the surface. But spreads are earned by liquidity providers. These participants, what they do is they quote prices, they manage inventory, they hedge risk, and continuously update based on flow. Their goal is not to predict, okay? It's strictly survival. Okay, spreads exist because liquidity provision is risky, especially when information is asymmetric, okay? And spreads are central to market stability. When spreads are stable, markets function smoothly. Volatility is contained and price discovery is orderly. But when they blow out, liquidity evaporates and feedback loops emerge and so on and so forth. So this is why microstructure really matters. Okay, systemic stress often starts with spreads. And if we connect this to the broader system, okay, zooming out, everything we've discussed across the series eventually funnels into spreads. Liquidity shortages, funding stress, macro shocks, okay, they all appear as wider spreads, thinner books, and rising execution cost. Okay, spreads are where macro meets micro. Okay, that's another way to put it. So now that we understand the price of immediacy, okay, the next question can start to become obvious. Okay, who provides that immediacy at scale in today's markets, modern markets? And what happens when speed itself becomes the strategy? In the next episode, episode 73, we'll explore high-frequency trading. Okay, are these liquidity providers or is it a fragility engine? Okay, because some of the tightest spreads in history are provided by the fastest traders. And understanding whether that stabilizes markets or makes them more fragile is essential to understand modern trading. Thank you for listening to episode 72 of the Global Ledger. We talked about understanding the price of immediacy, the bid-ask spread. Okay, we see it every day in the markets. And we talked about why they're important. Okay, this is where macro meets micro. Once again, I'm Justin, and thanks for being here.